Good afternoon, everyone. We will get started in a couple of minutes. And there's David. Okay, so we're ready to start. Hi, I'm Pamela Hastings, Relationship Manager at Barometer Capital. And joining me today, as always, is David Burrows, our Chief Investment Strategist here at Barometer. On today's webcast, we will provide you with a brief macro overview. And of course, at the tail end of our conversation, David would be pleased to address your questions one-on-one. So don't be shy. Email me at phastings@barometercapital.ca or hit me up on the Zoom link chat or Q&A section, and I will get to those. And with that, I will turn the conversation over to David. David, happy July 19th. Look forward to your update.
Well, Pam, we're here in the middle of July, what tends to be a little bit of a stronger period seasonally. We've had a better sort of 3 weeks since the lows we saw in June. And what I thought we'd do is just dive into taking a look at some of the things that have been going on market-wise. Market's been digesting just a ton of news. And one of the things I think is always interesting is not so much what the news is, but how the market's reacting to the news. And interesting, whether you look at some of the bankruptcies that have taken place in crypto, and crypto's rallied 25 or 30% over the last 3 weeks, or some of the bad news on inflation that supports the fact that the Fed is being quite hawkish. Market has absorbed this news after the last very difficult couple of months, and the market's moved a little bit higher. So, you know, the market is following the market as a process. There are not specific points in time that are relevant. It's what's happening at the margin and what changes are taking place that we care about. And so I thought I'd just kind of walk through what we're seeing. We're going to be pretty quick today because we're not making a lot of definitive statements other than making some basic observations. We continue to believe that we're in a structural bull market in stocks. It started in 2013. It is unlikely that this is over anytime soon. But like other structural bull markets, there are some pretty sharp pullbacks along the way. But the recessions that happen during bull markets tend to look, this is 1990-91, a lot different than the ones that happen in structural bear markets. And I will consistently highlight that in order to get a 45 or 50% sell-off, like 2007, 8, 9, or like 2000 through 2003, you need a recession and a crisis on top of that that may look like a banking crisis or a credit crisis of some type. And at this point, we just don't see it. As it sits right now, the pullback in the S&P has been commensurate with what we see during structural bull markets. And not to say it's not painful, it certainly is. But what we have to remember is what comes after these structural pullbacks. And they tend to be very smart runs higher. And so we don't want to get too bearish, but we do want to stay flexible and be in a position to position the portfolios as strength resumes. In the US, we think that we saw generational lows in rates in 2000, the COVID lows. And, you know, we sort of saw that confirmed as yields moved their way higher off the COVID lows and broke the trend that had been in place really since 1981. That marks, in my view, a shift from a disinflationary world to a reflationary world. And it doesn't mean that things go in a straight line. They move higher and they correct. We thought maybe we had seen the near-term highs in yield at 3.5% 10-year some weeks ago. And as we sit today, we're sitting at around 3%. 10-year yield has been unable to move higher from there. It may be that the bond market is starting to sense that higher rates in the short end will slow down growth enough that we may get a little bit of a backup in inflation, a pullback in inflation, and that would certainly be helpful to other asset classes. This is the TLT, the long end of the US bond market, the 20 to 30-year bond, down just a little over 40% off the highs at when we got to the lows. And we've now had 1, 2, 3, 4, 5 weeks the market doing a little bit of base building. And the bond market becoming and behaving a little bit more constructively. On commodities, we've been making a case that we've gone through, again, a structural low in commodities relative to other asset classes. But we've also been highlighting that when you get these turns, you do get sharp pullbacks along the way once things get underway. But very unlikely, again, that this new longer term strength in commodities relative to equities is over, probably just beginning. And this is the unweighted index of commodities, the RJI, or Rogers Commodity Index, from 2008 through 2021, when we broke that downtrend, moved smartly higher month by month. But we've had a 2-month quite sharp pullback in prices. About 2 weeks ago or 10 days ago, we saw lows. We've rallied off those lows a little bit. And so that the net of it is we look like we've seen a turn, but we're getting a sort of a cyclical pullback. This is a shorter term picture of that same chart. We pulled back to the rising 50-week moving average, which has tended to be support. We're holding in here. We'll see whether this holds or whether it weakens from here. But certainly we're watching it very closely. And there's the very short run picture bouncing off that 200-day moving average. Now, the strongest part of the commodity complex has been oil for a couple of reasons. First of all, we've been through a bear market in oil prices from 2014 through 2020. And in that period, we saw continued pullback in spending budgets by oil and gas exploration and production companies. And as a result, there is a structural shortage globally. As demand is picked up coming out of COVID, we know we have shortages around the world. And until we see a significant supply response, and it's tough to get one, we appear to be in deficit. So crude pulled right back to the rising 200-day moving average. We've rallied off that. So to this point, that is providing support. And of course, this is a longer term bear market that we've come out of. This is where you would like to see support come in and around the 200-day moving average. And we've seen that. This is natural gas, also quite constructive, having reversed a bear market in 2020. We've been moving higher highs and higher lows, and that continues to be in place as well. All of this, despite the fact that we have had record drawdowns in oil coming out of the US strategic petroleum reserves. So this doesn't look like it's going to stop soon, but it is not offsetting the structural deficit in the market. And oil companies currently, because of concerns around a recession, are really only discounting about $65 oil. So sitting here above $100 a barrel, these companies are just churning out cash. The agricultural commodities, again, reversed the long-term downtrend back in 2020. We've been moving higher and higher highs and higher lows. That continues to be intact. And so if we talk about it from a macro perspective, our base belief that continues to be supported by market data is that equities are in a structural bull market, but suffering a cyclical slowdown or correction, that yields have reversed 40 years of declining rates and moved into a reflationary world. So bearish bonds. And then third, when it comes to commodities, again, we've seen a long-term reversal. Tactically in the short run, they're correcting with concerns around what a Fed hiking cycle might mean for economic activity. But the net of it is the backdrop is positive long-term for commodities and for equities. Now, we make our decisions based on process, not on opinion. Our top-down work helps us to identify which buckets we would like to focus our attention in. We're looking for areas of the market that are showing expanding breadth. Then for specific ideas for the portfolios, the single security investments that we make, we do take a quantitative outlook to things. We look for a combination of about 20 factors in the income statement and the balance sheet that point to something going from being good to better. So good getting better. We don't ever look really for things that are broken, hoping that they're going to get fixed. We want to see price behavior support our fundamental view. In other words, strong relative performance relative to the market and relative to their industries. And by doing that, the portfolios get focused in areas of market leadership, in specific securities that have fundamental characteristics that are getting better. And then we manage those positions using stop losses, because if price behavior starts to contradict what we think is happening fundamentally, we got to make sure that a little mistake doesn't turn into a big one. So when we see some deterioration in market breadth, or we see some weakness in single securities, or we see deterioration in themes that we're using as market leadership, tends to be our cash position rises. And the important thing about that is when you get into a decline, it's not the first month or 2 or 3 that does the damage. It's month 6, 7, or 8 when the wheels are off the bus and the market is really in free fall. We want to make sure by the time we get to a vulnerable position for the market that we have a good cash weight and we have flexibility. And then we wait. What we're waiting for always is to show improvement in breadth. A few securities start rallying first, and in a healthy market, more and more securities rally along the way, meaning buying is spreading to more and more securities. As you go through a period where more and more securities are participating in a rally, generally coming from a very small number, behaving well at the beginning, that's a constructive environment. That means money's getting put to work. This often happens while the news continues to get worse. Markets discount future economic conditions by 6 to 9 months. So when people say it looks as though we may have a recession, whether a shallow one or something deeper, markets generally by that point are doing a pretty good job of discounting the likelihood of a recession. And when breadth starts to expand, that's the market looking beyond a potential recession. What we want to be careful of are parts of the market where we see deterioration in breadth. That maybe the leaders continue to perform well, but if the weaker securities within a group start to roll over, that tells us we should be careful. We shouldn't be putting on any new positions here. We should be tightening the stop losses that we have on underlying positions. And to the extent that new money comes in, it should stay out of that part of the market. Or if this is at the market level, out of the market as a whole. So our goal here isn't to be everywhere. Our goal is to target market leadership, areas that are relatively outperforming, where we see flows of capital getting put to work. And leadership can last for weeks or months or years. It's not for us to guess. It's just for us to measure. We're always looking for new leadership to emerge. In the absence of leadership, we sit on our hands and have a tendency to have an elevated cash weight, which is why over time, in general, when we got into broad-based declines, we get impacted a little more at the beginning, and it tends to be that it becomes quite muted as the cash position rises. So on June the 29th, all of our short-term and long-term indicators were negative, meaning breadth or the percentage of stocks performing well had been deteriorating. But we were getting to very low levels on the percent of stocks trading above their 50-day moving averages, globally for the US and for Canada. Also, the percent of stocks making new lows versus new highs was exceedingly low. Again, we don't try and guess at when that will change. We measure it daily. We highlighted the fact that when you got to a point where only 2% of companies in the S&P were trading above their 50-day, it was getting excessive and likely that the market would move higher in the short run. But you got to wait and see. Well, here we are. As of last week, we saw improvement on the percent of stocks in uptrends, percent of stocks in uptrends globally, percent of stocks trading above the 50-day moving average. And here we are as of today, we got a little bit more strength. So now about 30% of companies are trading back above their 50-day moving average. That's good. But the percent of stocks trading above their long-term moving average, the 150-day moving average, continues to be sloppy. Percent of stocks with positive weekly price momentum has moved up to almost 70%. So in the near term, price momentum has started to improve. Now, we don't know whether that's something that is lasting or whether it is a bounce in a down market. And we have to continue to try and read that data and understand what's happening internally, sector by sector. But in general, over the last 3 weeks, we've seen some net improvement. It's interesting that that happens on the S&P when we got to the 150-week moving average, which has often provided support during bull market corrections. This is where we were in early June. Since then, 1, 2, 3, 4, 5 weeks. And today, actually, we poked our heads above the high from the third week of rally, which again opens up higher targets. But don't get me wrong, we have declining shorter term moving averages, so the market probably has some work to do. But there's important things that we can take away from what's happening now. Of course, we want to see what it is that bounces first, because it means that there's interest. The problem is, if it is really weak parts of the market and the market starts to rally, you're going to see some short covering, people covering a bearish bet. You may also, though, see people buying, real buying for things they really want to own. What will be very useful is what happens when we actually get a little pullback over the next few weeks to see what gives back the gains. That was probably short covering buying taking place, and what holds the gains. In a market sell-off, you often have an initial low, a rally, and then a retest of the low. And when the market retests lows, we care about what has it been that's rallied and then held the gains while the market retests the lows. In 2003, the S&P 500 went significantly lower in March than it did in December. In 2009, it went decidedly lower in March than it did in December of 2008. Yet many fewer stocks broke down in the second sell-off. That told us where the strength was. So we spent a lot of time on this. Now, I understand why people are feeling negative and bearish. The market's been incredibly volatile. Over 90% of the days so far this year have seen 1% or greater swings intraday. Today, again, we saw that. But to the positive, NASDAQ was up 3.5%, a great follow through beyond those levels we talked about just now. But volatility is scary for people. But remember, the market discounts things quickly. Large speculators are the most short S&P futures we've seen since the middle of 2020. We highlighted that last week, but it continued this week. Aggregated US equity futures position as a percent of open interest is exceedingly short the market. That means people have built in hedges to reduce their risk. We know that cash levels are the highest we've seen since 2001. So over 20 years. So people have been repositioning their portfolios for tech investors since February of 2021, almost 18 months. And yes, there's been a terrible decline in unprofitable technology companies between then and now. And if people wanted to reduce their positions, they probably have gone about doing it. We know that investors in general believe there are very high risks out there by way of geopolitical risks, inflation, rising rates, and so on, inflation. But keep in mind that portfolio managers have now adjusted for that. So we have the percentage of portfolio manager taking higher than normal risks is lower than at any time since October of 2008, headed into the financial crisis. So positioning is cautious. Sentiment is very weak. We see on the bull bear, Bank of America bull bear indicator, it is the most bearish since 2002. So sentiment negative, that's a contrarian indicator. We prefer that to people being overly bullish. That's a little scary. The positioning is very defensive. Breadth readings, which we follow, got to exceedingly low levels, but are showing some improvement. So there is room for a summer rally, which we've talked about for a few weeks. It appears to be engaged. We've been watching certain levels on the S&P going back over the last month. We had these lower highs. We wanted to see it exceed those highs, which it did today. So market rallied very nicely through the course of the day. That opens up higher targets, sort of a couple of hundred S&P points higher before we get our next test. So let's talk about leadership. Energy continues to be the best group in the market. And it certainly pulled back 30% over 26 days from the middle of June to the middle of July. That's not insignificant. But on the year, it continues to be up over 30%. So certainly we got a sharp pullback. It found support at the 200-day moving average. And many of the companies behaved better than that. Now, I think it's interesting that despite the fact that oil prices have moved up as smartly as they have, the S&P 500 energy companies' percent of operating cash flow going into new CapEx has collapsed. And part of that may be that if you, of all of the CEOs, energy companies have the greatest ESG metrics built into CEO short-term incentive compensation plans. In other words, they're getting compensated for being environmentally friendly, which is great, but it means we are not seeing a supply response in a structural deficit. So today, Halliburton released their numbers. They're in the energy service business. They service oil rigs and oil fields. In their statement, they said they saw they were the most bullish on oil services they've been in decades, and they expect that the pickup in spending to try and increase production is likely to last years. So we've certainly had a sharp pullback, but there are lots of bullish points in the market, not the least of which is that major oil companies do actually have a history of outperforming during a difficult economic environment. Materials pulled back into support. We talked about this so far over the last 2 weeks, holding that support and rallying off it. The miners, we talked about having broken out of a multi-year bear market. They pulled back to the breakout point. They're holding support here. We'll see. The dividend growth stocks, have performed again quite well year to date. They're actually about flat year to date versus the S&P down 20. Even though they did pull back 10% in that month of June, which was so difficult, have held nicely and are rallying a little. Nice yield support here. So from a leadership perspective, long-term dividend growth appears to look very attractive. Relative price strength versus the S&P has really been strengthening since the beginning of this year. And we're seeing the same thing in the Canadian marketplace. So let's move beyond dividend specific themes. We've talked about utilities. We've talked about staples as being an important defensive place to hide. We talked a little bit about pharma acting well relative to the market. Actually, the pharmaceutical group is basically flat on the year. We've talked about aerospace and defense. It's down about 3% on the year, some pretty predictable revenues and earnings there. This week, we saw some improvement in regional banks. So again, much like the miners, after a multi-year bear market, they broke out, they've pulled back to long-term rising moving averages. This would be a natural place we see some support. So in the portfolios, one of the things that we did this week is we did add some Canadian bank exposure and some US regional bank exposure, given the fact that the breadth readings are showing some improvement in that group in particular for the markets overall. And we'll build on the position if this continues to hold and move higher. Value as a theme, down about 5% on the year, way better than the S&P. Had a stronger week. We're now trading well above the lows from the middle of June. And that probably has to do with the fact that valuations in more of the value camp are much, much lower than they are in the growth camp. Groups that have underperformed, acting a little better. For the first time, we saw a little bit of improvement in relative price behavior by consumer discretionary companies, but still in a long-term relative strength downtrend versus the market. Technology, a similar picture, a little improvement, but still in a long-term downtrend versus the market, not willing to make any significant exposure to here. And if we look across all of the groups, there's been lots of disparity in the performance over the last 5 days, but important economically sensitive groups actually acted much better over the last week. So what does that mean? It means we've still got a pretty defensive portfolio. It means we've got about 30% of the portfolio or just under in short-term government bonds, watching for confirmation that this strength over the last few weeks is something that could last. Our energy weight, again, we took down a little bit on the bounce. We'll look to see this group hold and continue to move higher, but we still have a much larger than market weight, about 3 times the S&P weight. Healthcare has grown a little bit on the strength in pharma and healthcare services. Consumer staples and utilities continue to be a very solid, stable dividend base. And I mentioned last week we had added a little bit of telecom exposure for the same reason. Between cash and bonds, we're about 35%. So about a third of a portfolio with flexibility to move as we go forward, because the most important thing is make sure that we don't have a little mistake turning into a big one. Industrials is our defense weight, which the companies will be reporting this week. We'll see how the numbers come in, but so far behaving quite well. Lockheed Martin came in and around what was expected. We still have a fairly lightweight in financials, technology, materials, consumer discretionary, real estate. So we continue to have a pretty cautious view. In our macro portfolio, we do have a bigger weight in energy, but this makes up oil and gas and uranium and lithium, all 3 important areas, all 3 actually relatively outperforming. We talked about adding a 10% weight in China a few weeks ago. Chinese market bottomed in April and has been moving higher since then. We do have about a 10% cash weight. We put in about 8% in US index exposure as the breadth models turned higher. We have a 7% weight in healthcare. We still have a weight in materials, which we will hold unless they break the long-term moving average, rising moving averages. Japan is about a 5% weight. Canada income-oriented securities is about 5%. Overall dividend weight of 4% specific dividend ETFs. And we put on a very small semiconductor exposure, 2.5%. Again, quite a cautious portfolio. So earnings are on tap. We're expected to get lots of earnings report over the next couple of weeks. We're going to have to see how they come in. We showed this last week that the average company had grown sales about 9%. Earnings growth was about 11%. We saw the trend continue that way this week. Revisions continue to be about flat. And from an inflation standpoint, we continue to believe that much like the early 1950s, the big pickup in demand that has pushed inflation higher is likely to back off some with tighter Fed policy. And if the market can start seeing past inflation, then we can see a market that can rally. We know that in the bond market, comparing regular 5-year bonds to 5-year inflation protected bonds, market is starting to believe that inflation can come out of the market. Other indications, we've seen some improvement in the inflation picture, which have not been in the recent inflation data. We've seen freight rates start to come down. We've seen used car pricing start to come down. We've seen mentions of labor shortage starting to come down. And we've seen commodity prices come lower. So we're going to continue to do this week by week. First half was very, very difficult, specifically the second quarter. And we know that historically, when you have a very difficult quarter, you tend to get bounces going forward. Markets discount things quite quickly. And in this case, with such a hawkish Fed, it may be that much of the pain has already been discounted. We continue to be in a structural bull market. Unless we start another leg lower, and we will watch closely for that, it is more likely that the market will chop around a bit for the next 2 or 3 months and then have its next major leg higher. If we get a slowdown in the economy and a reset in the supply chain and inflation starts to come out, that will give investors the license to look beyond a hawkish Fed cycle into the next reflationary push. So we'll watch it day by day. Treasury spread, corporate bond spreads, continue to be relatively benign, nothing like financial crisis territory. And as always, we will get more defensive if the data starts to weaken. But as it stands right now, I think we're in a pretty flexible position and able to take advantage of whatever comes out as leadership as we emerge from this recent corrective period. With that, Pam, if you got any questions, happy to answer them.
Thanks so much, David. Yes, Harry wants to know, given the inverted yield curve in the US, and with the euro dollar. David, do you believe there will be a significant recession?
Yeah, as we said earlier, I do think that it's very possible we have a recession, but I don't think that this is a hard landing scenario. Look, recessions are normal in a structural bull market, as we looked at. 1990-91 was a recession. It was a garden variety recession, and we may well have something like that. I don't think the market is telegraphing a 2008-9, and everybody wants to go to the worst case scenario. When you read commentators talking about and comparing this to a 2008 situation, you have to consider how they may be positioned. They're talking their book often. I think the market can give us clues. If we started to see credit spreads blow out and get much wider, okay, we got to get more cautious. If we saw the market break the recent support, maybe we got to get more cautious. I think that the inverted yield curve is telling us something, but it's also telling us there's another message you can take away. The bond market is now starting to believe that after short rates go higher, the long-term rates are going to come down. In other words, maybe inflation starts to come out of the picture. It would be probably more problematic if long rates kept pushing their way higher, which would mean the bond market believed that actually inflation was endemic and was going to be around for a long time. So as we always say, you can only take these day by day and step by step. You got to reposition for what you think is going on in the market. We have a particularly defensive view right now. We're not making any big bets on a quick V bottom in the market. I don't think that's likely. And I do think that the market is discounting a bit of a slowdown. But the way that we think some of the leadership groups have acted, it's more like a step back and a retracement than a rollover into some, terrible multi-year bear market, which we just don't think is that likely at this point.
Thanks, David. The next question comes from Dale. Dale wants to know if investors should be concerned about the Taiwan narrative.
Yeah, the Taiwan narrative is one that we got to watch. Let's see if I can pull up on my screen for you. This is the EWT. Sorry, just one moment. That's the Taiwan ETF. We're going to log scale, and we'll go back sort of for the extent of the bear market. Okay, so the Taiwan market has been in a bear market since 2001. We exited in 2020, and like the materials groups, pulled right back into long-term rising moving averages. I would say this is probably not a terrible entry point. In fact, I bought a little bit of the Taiwan ETF today for our macro portfolio. And I think that a lot of negative news on global economic activity has been built into the semiconductor companies. We've hit sort of logical support. If we were to break these support levels, I would stop my way out of the position. I think that there's lots of discussion around the geopolitics between China and the US and around Taiwan. I think that there is risk, but that's why the Taiwanese market has sold off the way that it has recently. It may well be that the short-term risks are sort of discounted right now.
Thank you, David. That concludes the questions we've received for this evening's program. So I will leave you, as always, with the final word.
Yeah, look, so Pam, we spent a lot of time looking across asset classes for clues. And, we know that, the unprofitable tech group rolled over and went into a bear market all the way back in February of 2021. And it has been a horrible bear market for people invested in those areas. It came back to the lows just before COVID and is trying to find some support in those areas after falling 80%. One of the things I think is interesting is that coincides with what happened in crypto. And
Dave,
so
we
if we were
can't
to,
see your screen. So I know you're trying to demonstrate.
so let's make sure we can see the screen. There we go.
Perfect.
So here's that ARC ETF, which fell 77%. So over the last few weeks, trying to find some kind of a low. We'll see. I do think it's interesting that coincides, that sell-off coincides with what happened in cryptocurrency, although it started later. What's interesting is that over the last couple of weeks, crypto's tried to find some kind of a short-term bottom. You've actually had a pretty good bounce off the bottom. This started before we started to see some strength in NASDAQ. If we can take some of the pressure of the liquidation of those types of securities off, it may well be there's some room to see a bit of a bounce. So, we look for clues. We'll see what happens going forward, and we'll report back weekly. But as it sits right now, we continue to be a little bit defensive. I think that we're going to probably see a bottoming process carved out over the next few weeks, maybe 2 to 3 months, but we may have seen the lows already market-wise. I have a lot of respect for three groups. Ned Davis Research, which believes the bottom is in. Leon Tui, who believes the bottom is in. And Jeffrey Sote, who believes that we've seen a near-term bottom, and there's a good chance that was the low for the sell-off. We don't make those kinds of projections. All I can say is our data is getting a little bit better. We've found some groups that we can maybe add a little bit to, and we'll take it day by day. Thanks, Pam. And thanks
Thanks, David. Have a great evening.